The Chinese stock market suddenly surged. What happened, or what did it get hit by? Did something happen in China, or was there a new policy? Why did the mainland Chinese stock market shoot up so dramatically, the strongest in a decade? And when things take off in mainland China, it doesn't just stay there. It crosses borders into the Hong Kong stock market too. In mid-August, there was an inflow of $4.6 billion. And most importantly, it makes you wonder, hey, is the Chinese economy about to make a comeback? No, that's not it. It's because of the real estate sector. Chinese real estate stocks suddenly rallied together as a group. So what happened? What triggered this? Was there a new policy or something good announced? In this video, I'll tell you. When it comes to the economy, it's worth paying attention. Let's take a look together and support this video to find out why the Chinese stock market surged so strongly and what exactly caused it. You can join in by scanning this QR code or support the channel as well. You can easily support me, Monster, by liking, sharing, and commenting. Just interact like you normally do. And most importantly, if you haven't subscribed yet, please hit that subscribe button so we can catch up next time I post a new video. Sound good? Thank you. If we want to understand the economy, we have to look at the charts, right? Because your eyes can't deceive you. It's not just because numbers are hard to fake. Sometimes they've been manipulated from the very beginning. But with charts, you can really see what's going on. For example, the Shanghai Stock Exchange Composite Index just closed at its highest point in the past decade. This happened around mid-month, when it rose by 0.9% to reach 3,728 points. Wow, according to Bloomberg, do you know what these numbers mean? Do you know how it managed to go up this much? It's actually risen by 20%. From when, you ask? From the day the Chinese market totally crashed, a Liberation Day this past April, when Donald Trump announced trade tariffs against pretty much every country in the world, especially China, which got hit the hardest. Back then, the Chinese market was shocked and dropped sharply, but now it's up 20%. This recovery in the Chinese stock market has really energized the market. There's been a surge in trading activity. The trading volume on mainland China's stock market has hit its highest in a decade, $376 billion. With this much trading going on, if stocks didn't go up, that would be a problem. And this aggressive, heavy investment surge in mainland China isn't just staying within the country. It's spreading to its neighboring markets too, like the Hong Kong Stock Exchange, the Hang Seng. Bloomberg reports that with so many people in mainland China buying stocks, the momentum has spilled over into the Hong Kong market, causing capital to flow in. The Hong Kong market saw inflows of up to $4.6 billion US. This figure comes from investors in mainland China, and it's the highest amount ever recorded. Coming back to my own thoughts, when I see this happening, it makes me think of something. I've always liked the idea of capital inflows. Wherever the money goes, I want to be there waiting. So when I see money flowing into the Hong Kong market like this, I think there's one stock that really stands out. I decided to buy shares in Hong Kong exchanges and clearing. Number 11, HKEX. Have you heard of it? It's the Hong Kong Exchanges and Clearing Limited, which is listed on the Hong Kong Stock Exchange. HKEX acts as a bridge between large public companies in mainland China and the Hong Kong Stock Exchange. This makes it easier for foreign investors to access big Chinese companies. Normally, it's not easy for foreign investors to buy shares in Chinese companies directly, but if those companies are listed in Hong Kong, it becomes much easier to buy them. We can buy them too. But as for where to buy them, you'll have to figure that out yourself, okay? Another thing is, when I look at HKEX's revenue structure, you can see the proportions of where their income comes from. Some sources contribute more, some less. The largest portion of HKEX's revenue, 48%, comes from stock trading. That means if there's more stock trading, HKEX's revenue will increase. Another interesting point is that the second largest source of HKEX's revenue comes from Stock Connect. Stock Connect, the stocks that are connected to mainland China, account for 24% of HKEX's revenue. So if Chinese stocks from the mainland start to boom, the money will flow over here. I'm just showing you my way of thinking, since a lot of people ask how to use news like this for investing. This is basically how I think about it. But if anyone wants to buy stocks just because I said something, that's on you. I'm not recommending you buy. In this clip, yes, I talk a lot about stocks, so I made this video. No sponsors, and let me emphasize again that I'm not encouraging anyone to buy. I'm just sharing my way of thinking. I'm not saying whether I'm buying or not. You have to do your own research. Now back to the stock market. On the mainland China Stock Exchange side, Wang Huan, a fund manager from Shanghai Secure Investment Management, said this: "We're confident that this market upswing can continue." Wang Huan gave reasons why it can keep going, mainly because of the capital inflows and the supportive policies from the Chinese government. As for other key economic factors that could help the Chinese stock market keep moving forward, Wang Huan mentioned them as well. AI is booming more and more, and if we look at the Chinese government bonds, the 10-year Chinese government bond yield has risen by 4 basis points to 1.78%. The 30-year government bond yield has increased by about 6 basis points and is now at 2.11%. These are the returns. But just because yields are rising like this, it doesn't mean the market is all good. It's not just that. We also have to consider the risks. So if you ask why the Chinese market suddenly rebounded and went up, so what is this risk? Let's go back to the first chart. In the first chart, we can see that the Chinese market has gone up, yes, but it's still not as high as when it peaked in 2015. Back then, it reached 5,166 points. That was the peak. After that, after it hit the peak of 5,166 points in 2015, it dropped sharply. That was when China's bubble burst. And importantly, so we don't overhype China, we have to say that the rebound in the Chinese market, this isn't happening only in China. The Chinese market bouncing back is just part of the recovery happening in many markets around the world. The US stock market has also risen significantly, and the Indonesian stock market just hit an all-time high. All of this has pushed up the indices. So, as I said, if you don't want to pick individual stocks, just go with the index. The fact that markets around the world are rising together like this has pushed the MSCI World Index to its highest level ever. If picking individual stocks is too much for you, but you still believe the world can keep growing, try investing in a global equity fund at any financial institution you trust and feel is safe. It's better than just leaving your money sitting in the bank, and definitely better than spending it all shopping. And another point I see is that, or maybe it'll make a comeback? This makes the Chinese market look a lot more interesting, especially because the Chinese government has a policy to aggressively stimulate the real estate sector again in a big way. Why am I interested? Because when the government steps in to boost real estate, the main reason the Chinese economy has been in such a mess is because of the collapse of the real estate sector there. So if the real estate sector can recover, then the Chinese economy can recover too. The sign I've seen that suggests a comeback is that on August 25th, Chinese real estate stocks suddenly surged, up 3% in just 1 month. For example, China Vanke, a Chinese real estate company that reported losses in the first quarter of 2025, suddenly saw its stock jump 16%. And then there's another company, Sinac China. So at that time, Sunac's stock also shot up by 13%. So you might wonder, what caused such a big jump? It was the government. Right now, as I mentioned, the Chinese government is stepping up efforts to support the real estate sector and push for a quick recovery. What has the government done? They've taken several measures, like easing restrictions on buying homes in suburban areas, which used to be limited. Previously, if you didn't live in Shanghai, you couldn't buy property there. But now they've changed the rules to make it easier. Residents from outside Shanghai who meet the qualifications are now allowed to buy homes, and there's no limit on the number they can purchase. For example, previously, if you didn't live in Shanghai, you weren't allowed to buy property there. But now, under the new rules, if you're from outside Shanghai and have paid into the pension fund for 3 years, you can buy a home. And importantly, you can buy a new property, not just a secondhand one. Before, they didn't allow non-residents to buy new homes. This measure has been well received by analysts like Jeff Fong, a real estate analyst from Morningstar, who said that this move by Shanghai is clearly a positive for the real estate sector because it directly addresses a key issue, making it easier for people to buy homes. That means the unsold housing stock can finally be cleared out and sold more easily. The backlog of unsold homes has been a real problem. According to data from Tosper, in the suburbs of Shanghai, as much as 80% of the housing stock is unsold. With such a high percentage, it's no wonder home prices haven't gone up. They're still falling, still in the negative. Now, let's take a look at what the Chinese government is doing about this. So what does the Chinese government say about the recovery from the real estate crisis? Let me share with you the words of Premier Li Cheng. Premier Li Qiang mentioned at Davos that this real estate crisis, with home prices dropping like this, is only going to be temporary. That's because the rate of people moving from rural areas into the cities in China is still steadily increasing. And with this rate, there will soon be more people living in the cities. Most importantly, those who move into the city, they're all middle class people with purchasing power. And of course, they'll have demand, they'll want to buy homes. So all these unsold homes, it won't be long before the supply matches the demand. And after that, there will be a shortage again, just like before, which will push prices back up. Premier Li Qiang believes that after being in the negative, prices will bounce back into positive territory. But in reality, we'll have to wait and see. Premier Li Qiang has made solving the real estate problem a top priority because at the cabinet meeting in mid-August, previously, Li Qiang made it clear that stopping the decline in real estate is something that needs immediate action. Honestly, is it okay that they're doing it now? Well, it's better than doing nothing. But in reality, investors have been expecting the Chinese government to take this kind of action since March. Because at the National People's Congress, NPC meeting back in March, the Chinese government said they would ease restrictions to stimulate demand, removing all restrictions. Some investors expected action immediately after the March announcement, but it didn't happen then. Still, the government finally acted. Now, demand can grow freely without limits, which should help reduce housing stock. Shanghai suburbs previously had 80% stock, so they expect higher sales. As stock drops, prices should rise. And this policy... Next, the government is lowering the cost of getting a mortgage by reducing interest rates for second homes. Normally in China, loans for a second home have higher rates than first ones. Now, the government will make the interest rates for both the same. This, as an incentive, encourages multiple home purchases. Finally, to stay modern, they are injecting liquidity into the system by increasing the credit limits. The House Provident Fund has been raised to 2.16 million yuan, which is about 302 billion US dollars. This home loan offers a lower interest rate than other types of loans, around 0.45%. And there's another promotion. People who have deposited money into the fund are now allowed to withdraw from it to use as a down payment on a house. So with all these policies the Chinese government is implementing, will they succeed in improving China's economy? Will it work in the short term? No one knows, because the pain from the real estate crisis in China runs deep. But I do have one indicator that can give us a pretty good idea of whether China's economic health is recovering: the index that tracks housing prices in China. This index shows year-on-year changes, how much prices have gone up or down compared to the previous year. If you look at the graph, you'll see that housing prices shot up a lot, especially 5 years ago, before the crisis hit. Back then, the real estate market in China was still doing well, but after prices peaked, they just kept dropping and dropping, falling over and over again. That's what led to the real estate crisis in China, which was a total disaster. Housing prices plummeted, going deep into negative territory, and kept dropping even further. By 2024, the decline hit its worst point. Now, if you look, prices are still negative, but the drop is getting smaller and smaller. The steep peak level declines are gradually easing up. Now, if we want to know whether China's economy can recover, we can monitor this indicator. If housing prices keep becoming less negative and eventually turn positive, then there's a chance the Chinese economy could bounce back. But if the government keeps pumping in money and using strong measures, yet housing prices still can't rise, that means the policies they've implemented might once again be ineffective, and the sluggish parts of China's economy will probably remain sluggish for a long time.